Okay, think about this for a second. The whole financial world, it runs on trust, right? But how do we actually know the numbers are solid? The company reports, the valuations. What if the people checking them, the auditors, miss something big, give the wrong opinion? Well, that's what we're diving into today, this key idea that acts as a safeguard against that very risk. We're tackling audit risk. It sounds technical, maybe, but it's absolutely fundamental. We'll unpack what it means, why it's so critical for audits, and how auditors actually manage it. We're drawing on an expert article that gets right into the international standards on auditing, the ISAs. Stick with us, and by the end, you'll really get these sort of unseen forces shaping financial cut to understanding something that honestly underpins global business. Ready? Let's get into it. All right, so audit risk. What are we actually talking about here? The official definition from the IASB glossary.
It defines it as the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated.
So basically, the risk, the auditor says everything looks okay when in fact there's a major error or problem.
Exactly. They give it the green light when there's a significant misstatement hidden in there. And then you have to understand, this isn't just some abstract concept. It comes from pure practical necessity.
Right, because auditors can't check every single thing, can they?
No way. Imagine a huge company, the millions, maybe billions of transactions hitting their income statement or balance sheet, trying to verify every single one. It's not feasible.
Yeah.
Nobody could afford it, and it would take forever, like counting grains of sand, you said. So that impossibility, that's really why the whole risk-based approach exists in auditing.
Okay, so it's about being smart with their time and effort.
Precisely. Efficiency, yes, but also effectiveness. You focus the audit work, the testing, on the key risks or significant risks. These are the areas where things are most likely to go wrong. Where an error could actually be material, could mislead someone reading the accounts.
And figuring out what is a key risk, that takes judgment.
Oh, absolutely. It's a core part of the auditor's professional judgment based on their understanding.
And this isn't just auditors deciding off the cuff. The standards, the ISAs, they actually require this risk-based approach.
That's right. The international standards on auditing really provide the framework, the rules of the road, mandating this focus.
Okay, so let's talk about those specific standards. There are a couple of key ISAs here. First up, ISA 200. That one introduces professional skepticism. What does that actually mean in practice?
Professional skepticism. It's crucial. ISA 200 describes it as an attitude that includes a questioning mind and a critical assessment of evidence.
So not taking things at face value.
Exactly. It's like having an internal prove it button. You don't assume management is dishonest, but you also don't assume they're infallible. You need evidence.
You question things, look deeper, especially if something seems a bit off.
Yes. It's that mindset that helps auditors spot potential misstatements, things that might otherwise be missed. It's absolutely vital.
Got it. Then there's the big one, ISA 315. I've seen it called the single biggest change in auditing standards in recent years. That sounds pretty major.
It really was, yeah.
What makes ISA 315? Identifying and assessing the risks of material misstatement. Quite a mouthful. Through understanding the entity and its environment, such a game changer.
Well, it fundamentally shifted the focus. Maybe in the past, some audits could feel a bit like ticking boxes. ISA 315 really forces auditors to get a much, much deeper understanding of the company they're auditing before they even design their tests.
Understanding its business, its industry, how it works internally.
All of that. Its strategy, its operations, its internal controls, the pressures it faces. You need that deep context to properly identify where the real risks might lie. It's not just looking at numbers, it's understanding the story behind the numbers. It lays out this very structured 4-stage process to build that understanding.
Okay, so it's about context driving the audit work. Let's walk through those 4 stages. How do they connect?
All right, stage 1 is all about the initial risk assessment procedures. The standard mandates 3 specific things auditors must do here.
Okay, what are they?
First, inquiries. Talking to management, yes, but also others within the company, asking about their objectives, expectations, plans, risks they see. It's structured discussion.
Getting the inside perspective.
Exactly. Second, analytical procedures. This means looking at financial data, non-financial data too, identifying trends, anomalies, unusual relationships, things that just don't quite add up.
Spotting red flags in the data.
You got it. And third, observation and inspection. Actually watching processes, looking at key documents, inspecting facilities, seeing things firsthand.
So talking, analyzing, and seeing.
Yes, and critically, it has to be a combination of these. You can't just do one. Another key part of this stage, the engagement partner and the core audit team have to discuss the company's susceptibility to material misstatement. Brainstorm together.
Right, so those three procedures kick things off, give them a starting point. What comes next to really build that deep understanding? Stage 2, right? Understanding the entity.
Absolutely. Stage 2 is where you synthesize all that information. It's about getting that detailed grasp of the entity, its environment, and crucially, its system of internal control.
Why is understanding internal controls so important here?
Because controls are the company's own safety net. If they're well designed and working, they can prevent or detect errors. If they're weak, well, the risk of misstatement goes up.
So understanding controls helps assess the risk.
Definitely. This whole stage, understanding the business, the environment, the controls, it's essential for identifying the risks accurately, for designing audit tests that actually respond to those specific risks, and for gathering enough good evidence.
Okay, that makes a lot of sense. So they've done the procedures, they've built this understanding. Now, how do they pinpoint the most important risks, the significant ones?
That's stage 3. Identifying and assessing significant risks. Here, the auditor uses their judgment, guided by the standard, to decide which risks need special attention.
And the standard gives pointers on what to look for.
Yes, it lists specific factors to consider. For example, is it a risk of fraud? Fraud risk gets immediate special attention. Also, risks tied to recent big changes, economic shifts, new accounting rules, major industry developments, anything new and potentially disruptive.
Things that change the game for the company.
Right. Then there's the complexity of transactions. Think intricate financial derivatives or multi-layered contracts. Complexity breeds risk.
More chances for things to go wrong or be misunderstood.
Exactly. Also, significant deals with related parties transactions between a company and its owners or management, maybe not at arm's length, those need scrutiny.
Because the incentives might be different.
Potentially. Then the degree of subjectivity in financial measurement. Things like complex valuations or provisions where there's a wide range of possible outcomes, high estimation uncertainty.
Where it's not just counting cash, but making judgments.
Precisely. And finally, significant transactions that are outside the normal course of business or just look plain unusual. These often warrant a closer look. Any of these factors can flag a risk as significant.
Okay, a lot to consider there. And then just quickly, there's a fourth stage relating to ISA 330.
Yeah, stage 4 is essentially linking this assessment to the response. ISA 330 is the standard that guides the auditor on what tests to perform, how much testing, based on the risks identified in ISA 315. It closes the loop.
Now, something important to clarify, we're talking about audit risk, but people might also hear the term business risk. They sound similar, but they're different, aren't they?
Very different, yes. That's a common point of confusion. Business risk is much, much broader. ISA 315 actually defines it. It's about risks from conditions, events, actions, whatever, that could stop a company from achieving its objectives or executing its strategies.
So like the risk of a competitor launching a better product or a recession hitting their market.
Exactly. Risks to the business's success and survival. Audit risk is specifically narrower. It's the risk of the auditor getting their opinion wrong on the financial statements. One is about the company's health, the other about the auditor's judgment on the report card.
Got it. And before we wrap up the core concepts, let's touch on the traditional audit risk model. It's still relevant, right? Even with ISA 315.
Oh, absolutely. It's a really useful framework for thinking about the different components. It breaks audit risk down into 3 pieces.
Okay, what are they?
First, there's inherent risk. Think of this as the raw riskiness of an account or transaction before you even consider any controls the company has. Some things are just naturally more prone to error.
Like complex calculations or estimates?
Yeah, or accounts susceptible to theft, perhaps. It's the risk inherent in the thing itself.
Okay, inherent risk. What's next?
Then you have control risk. This is the risk that the company's own internal controls won't prevent or catch a material misstatement that occurs.
So their safety net has a hole in it.
Kind of, yeah. Maybe the control isn't designed well, or maybe it is, but people aren't actually doing it properly.
Right. And the third component?
That's detection risk. This is the risk that the auditor's procedures or tests will fail to detect a material misstatement that has occurred and wasn't caught by the internal controls.
So this is the risk the auditor themselves misses something.
Exactly. It's the risk that our net doesn't catch what slipped through the company's net. The interplay between these three is how auditors manage the overall audit risk down to an acceptably low level. But understanding the separate parts is key.
So bringing this all together for our listeners, this isn't just theory. Audit risk is intensely practical.
Absolutely. You can't just learn the definitions. Auditors and students learning this need to apply it. Think critically about real situations. Design sensible risk assessment procedures.
It's about judgment, application, not just rote memorization.
Definitely. And it's worth noting this approach, particularly around ISA 315, is pretty consistent globally. The UK and Irish standards, for instance, are very closely aligned, so it's a widely accepted way of thinking.
Good to know. Global consistency there. Okay, so let's recap. Audit risk, it's this vital concept that lets auditors do their job effectively, efficiently, ensuring trust in financial reports without, checking every single penny.
It's a sophisticated, standards-based response to a huge practical challenge.
Absolutely. It underpins so much of our financial world. So here's a final thought to leave you with. We've talked about how auditors use this structured, skeptical, evidence-based approach to assess risk in financial information. Think about how you could maybe apply some of that thinking when you evaluate information, make decisions, whether at work or personally. Could adopting a more questioning mindset, looking beyond the surface, considering the context, could that help you uncover hidden risks or gain deeper insights? Something to mull over.